Are you worried? Are there excessive layers of complacency out there right now?
I don't think so. With respect to Mr. Corbett, I think the markets probably have the story correct. Global coordinated growth is what's happening now, and it's a little bit hard to derail that in a short period of time. I think we would all agree that a 10% correction is in the cards at some point. None of our crystal balls would tell you when. But I think the underpinnings of the economy globally are strong enough that that's probably a buying opportunity. And so I don't think Mr. Corbett's fear that we're sort of over-reliant is right in a grand sense. But in a shorter-term sense, yeah, I think the crowded trade in the markets has become selling vol. That is the crowded trade. And I think that will reverse. Higher rates will generate more dispersion of companies, more volatility. And so as you see the 10-year in the U.S. climb towards 3%, you're going to see some more volatility in the markets.
And more volatility, how does that play into the active versus passive? I know you want to move the conversation onto active and passive versus and. Very important distinctions.
Yes, I think a lot of people think that passive and active are substitutes for each other. I think they're much more complements. It doesn't make sense in a world to have all passive. Passive isn't a good capital allocator. It free rides on the relationship between the stocks in an index that are set by capital allocators like active. I don't think passive is going away either. It's a good baseline choice. It's inexpensive, and it'll have a big part of the market on a go-forward basis. So the best asset allocators are going to use active and passive in concert with each other. And I think that's a good result for our clients. It's a cost-effective way for them to invest, and we support it.
Well, so how do you charge for that then, Dick? What would be the correct fee for such an approach?
Well, I think in general, active should charge a reasonable percentage of the outperformance it generates after fees. And you can do that in a number of different formats. In institutional market space, performance fees make rather more sense, because you have a long relationship with a client where they can adjust the fee that that client is paying you. In a retail market, it may make rather less sense in the sense that a shorter holding period means that if a mutual fund is constantly adjusting the fee that it charges, typically new investors are paying for performance received by other investors, and they may leave before ever paying the fee for their own performance. And so it doesn't work as well in a retail context. But in an institutional context, I think performance fees are the right thought. You just have to have a reasonable amount of base fee, because otherwise you're incenting too much risk taking.
Yeah. So Dick, when a new client comes to you and says, okay, I like this idea of, active and passive, maybe trading in and out of ETFs, how do you funnel their money? Where do you send it?
Well, I think the first thing to say is we're optimistic about the future of risk assets right here in the global economy. So we think that you should be pretty close to your core base asset allocation, whatever that may be measured against your liabilities. And so we think investors, the difference between a professional investor and an amateur investor is typically staying with a framework. And so this is no time to vary from your framework. You need to be there. And then as you think about mixing active and passive, you need to think about how good am I at selecting active managers. If you're not very good, you'd have a relatively lower share of active managers. If you feel like you're pretty good, I think, and if you have a long holding period, I think you can be quite confident that a good active manager will deliver significant outperformance over the index and passive over reasonable time periods like 5 and certainly 10 years.